Tracking shares of Under Armour here. They are climbing after better than expected earnings and a strong outlook overshadowing its steady decline in revenue. Weak sales across the U.S. and a slowdown in its wholesale business among the biggest challenges for the retailer. We've got David Swartz, who is the Morningstar Equity Analyst, here with us. David, great to see you. Just take us into what is at play more long-term for this outlook from Under Armour and where they're sitting right now within this mix of athletic apparel and footwear companies.
Right now, Under Armour is struggling for the most part. The company has no sales growth. Its sales were down more in the quarter from last year than I expected. And really, if you listen to the conference call, the company didn't really explain that anything's going to change in the near term. It's really going to take several quarters before we see a lot of new product and a lot of new strategies that are really going to drive any top line growth. Now, this is not entirely Under Armour's fault, of course, because right now the sportswear market is pretty challenged. In just the last few weeks, we've heard pretty dim outlooks from Puma, Adidas, and Nike. So right now it's kind of a tough market. And so Under Armour is trying to really drive growth in a period that's pretty tough for the industry.
So David, where does that leave Under Armour then from here? Because when you take a look at those inventory levels, yes, there was some improvement in the most recent quarter, but still not to the degree as maybe we were hoping to see some of that improvement. Obviously, going back to your previous point, Under Armour not alone in this, but in terms of what that inventory level looks like over the coming quarters, do you expect more material improvement there?
I think we will see improvement, but the problem is that wholesale orders right now are very low. The wholesale orders, especially in the U.S., are way below normal. And so it's very difficult to actually manage your inventory when stuff is not selling through and it's not being sold to your retail customers. One of Under Armour's biggest problems is that it's too dependent on the wholesale market. It's dependent on department stores like Kohl's. It's dependent on also sporting goods stores too. And so a lot of it depends on how healthy they are. And right now, their orders and sales are not that strong. And so that's affecting Under Armour's ability to manage its inventory.
You know, David, we've been tracking some of the announcements from footwear, athletic footwear specific companies, and the innovation that some of them are trying to put forward this year and take to market, whether that's new entrants like Lululemon trying to finally get into men's footwear, and then you've got Nike with Air Max DN, which that comes ahead of Air Max Day. You've also got the chunky soles at Hoka on running. We could go down the list. What does innovation from Under Armour look like this year? And is that something that investors can hang their hat on?
I don't see a lot of innovation from Under Armour right now. And to be honest, it doesn't look like the company is really planning that much this year. A lot of the real product development cycle is really geared towards 2025, it seems like, at Under Armour. We've been warned about this. The company is going into more casual sportswear rather than its traditional performance sportswear. But it has explained to us that it's going to take some time for that to happen. The company has a designer, John Varvatos, used to be a pretty well-known fashion designer on his own, who's now the lead designer for Under Armour. But we've been told that it's going to take some time for his products to actually reach the market, given the long lead times in this industry, which can be as easily 18 months from the time that a product is designed to the time that it actually reaches consumers. So I don't think we're going to see a lot of innovation really in the short term for Under Armour, and I think that's part of the reason why the stock is depressed.
David, do you think it's time for a brand reevaluation? I bring this up just because we're in the midst of a turnaround. You're saying it's going to take longer than maybe initially anticipated here to play out. Should Under Armour be further adjusting its business given the shift that we're seeing in consumer spending?
Under Armour really has been in a turnaround situation for about 7 or 8 years now. So there have been a lot of changes, and I think some of them have been positive. I don't think it's a situation where the company needs to panic in any way. Under Armour does have a strong cash flow this year. Its inventories are much better. Its balance sheet is very good. The company has minimal debt. So Under Armour really is not under any great pressure to turn things around right now. The stock price is clearly low here in the single digits, and that's a concern. But the company is not in any risk of distress. It's really just a matter of trying to generate top line growth again, which has been Under Armour's problem for years.
You know, David, one of the huge efforts that we've seen is leaning into the athletes. They've leaned into Steph Curry. They got the Curry brand there. They've leaned into The Rock. And for these different brands, I wonder, because we've seen Nike do this effectively as well, where they've been able to grow out Jordan brand for decades. Are any of these brands, kind of from the analyst perspective, tracking up against that similar growth that a sub-brand should also be taking on and being a net contributor to the overall performance for the company?
If Under Armour is really ever going to be competitive with Jordan and other top tier brands, it needs to produce better footwear than we've seen traditionally from the company. Steph Curry is extremely popular. He's a great player, but he alone cannot drive Under Armour's footwear sales. The company still needs to put out shoes that people want to buy and that the collectors want. The company has talked a lot about its loyalty program. The CEO, Stephanie Linnartz, who came from Marriott, was involved heavily in Marriott's loyalty program. But a loyalty program does not help if you don't have the products that people want. And so it really does come down to innovation and style, as well as having relationships with popular athletes like Steph Curry.
Would love to know who your top pick in this space is right now, David.
Well, right now, I do think Under Armour is quite undervalued. My fair value estimate on it is $15.50. So I think it's trading at about half of what it really should be. It's trading at a low PE. Now, I recognize that the bottom line growth is not really there, but I do think it's actually at a buy at this level. There are other companies, too, that I think are quite undervalued. VF reported earlier this week. VF has serious problems. The company is doing a complete transformation, but I think the stock is way undervalued. And I think that people have just basically given up on any chance of it turning around. But VF has some significant brands, and some of them may be sold pretty soon, which I think will alleviate their debt problems. But I think so. VF and Under Armour would be two that I would highlight as being quite undervalued right now.
All right, David Swartz, always great to get your insight there. Morningstar's equity analyst. Thanks so much.
Thank you.